Hey guys, it's Hank here. I'm going to do a video on valuation because most people's equity is in their homes, and right now we can see the market's crashing, and I guess what's on everybody's mind is how much is my house really worth if it weren't all pumped up and inflated? Well, there's a couple of different factors that I would use and am using to determine what real valuation is for home prices. But I figure we should probably go over the first factor so we can kind of see the changes over time. And I've been thinking about the economic collapse for quite a long time, and alternatives to the system and all sorts of different things like that. But things have gotten considerably more difficult to work out now that I have to think about a planetary body moving through the solar system at a right angle, which explains a whole lot more. But just when you think you've got it all figured out, there's always something more to learn. So yeah, I could beat a Great Depression, but I'm not sure if I can beat planetary body moving through the solar system at a right angle. I'll try and figure that one out too. Okay, but let's just go over what I've been working on for a while. And valuation of home prices, and this is the first factor. And we're going to look at the median sale price of new homes, and I want to emphasize that point. We're talking about new homes sold in the United States. My parakeets are all talking to one another. And we're going to go all the way back to 1963, and we're going to hit a series of 4 periods, basically, and 3 events, so we can understand some of the mechanics behind why the market has changed and what that means. So we're kind of getting a historical perspective so we can understand what the future is going to look like, because history and markets and prices and all these things, they run in cycles. So if you want to understand what the future looks like, you often have to look at the past. So back in January of 1963, the median home price in new home price in America was $17,200. Now by December of 1970, the median price was $22,000 or $22,300. So over 7 years, the change in median home prices was $5,100, and that essentially works out to about $728 per year in increase in price for the median home price. I couldn't find any data on average home prices of that period. Now, why is that so important? Well, the first event happens in January of 1971, or maybe it wasn't January of 1971, but sometime in 1971, it was the end of the gold and silver standard, and we went straight to fiat based on the petrodollar. And I've done a video on petrodollar, so if you want to understand the mechanics of that, you can take a look at that video. But this is when we begin to see a rapid increase in inflation, because we're not tied to anything but fiat. So there's no, it's not a closed system anymore. It's only closed in respect to the United States' ability to be able to enforce trade in dollars for oil. That's what gives the petrodollar value. You know, people often, I hear this all the time, well, if we can just print as much money as we want, why can't we buy anything we want? Well, it was all predicated on being able to control the oil and having other countries have a certain amount of US dollar reserves in order to purchase oil or to transact business between countries. It would be done in the dollar. The one world currency was the dollar at the end of World War II. And for a while, everybody agreed on it because it was stable, solid because it was backed by physically assayable gold and silver. That all changed with Nixon. So we look at January of 1971, the median home price was $23,900. And by December of 1981, the median home price was $68,400. And the average home price was $82,000 flat. Now that means in a 10-year period, we had a change between median prices of $44,500 in roughly 10 years. So that's basically $4,450 per year. So even in those initial 10 years coming off of the gold standard and going into the petrodollar, you're seeing a tremendous difference in the percent change of median home price per year. So from 728 a year over 7 years to 4,450 a year every year for 10 years. Okay. So that's percent change roughly about 65%. And up here, the percent change is roughly 30%. And the reason that this is only the first factor of a new series of valuations is we're also going to take into account in the future what wages are and what debt loads are and construction costs, material costs, things like that, to give a new, to present a new set of valuations. Okay, so event 2 is when home prices begin to separate from wage growth, okay? Because all this is not really important as long as wages are keeping up with inflation in home prices. So it stays, your housing costs about 33% of your overall budget would be a healthy amount for a home to cost, for your housing to be 33% of your earnings. It was a pretty standard rule and model before the banksters got all involved with it and really took it to the next level. Okay. Well, we're only looking at roughly 2-year period here from January of 1982, where the median home price was $66,200. Average home price was $78,000, to December of 1983, where the median home price was $75,900 and the average was $91,700. Okay. So in 2 years, we have a change in median home price of $9,700, which works out to about $4,850 per year. So it's very close to when they went off the gold standard. It's still a pretty, I don't want to use the word average, but pretty typical since they went off the gold standard. Not too much has changed here. But what is changing during this event is that the home prices are beginning to separate from wage growth. Now, you could understand that America would be in a boom period, you know, coming off of the gold standard, because a lot of that money can be infused into the economy. Also, we're exporting a lot of inflation around the world because of the petrodollar. That's a whole nother topic, a whole nother discussion for a whole nother time. But I think you can kind of see where this is going. So by event 3, and we're going to take a look at January of 1984 to October of 2011. In 1984, the home prices to wage growth, we're seeing an accelerated divergence between what people earn and what housing prices are going to, because of speculation. And really gets bad. I mean, you got all kinds of things with savings and loan scandal. You got Fannie Mae and Freddie Mac, and you've got all sorts of other government subsidies, ninja loans, Glass-Steagall is repealed. A ton of stuff happens in the 90s to break down the barriers that existed, that they put into place actually after the first Great Depression, to separate the investment houses from the banks, from the physical markets, or like your speculative markets, like pork, beef, sugar, your COMEX, and all that stuff. They each individually used to be different things. You had Wall Street was separated from the banks, and was separated from the government, and all these things start to kind of get intertwined. And there's a whole lot to that. There's a lot more to explain with that, but it's not really vital to the discussion at this juncture. But the important thing to note is that the home price to wage growth is seeing an accelerated divergence. Okay, so in January of 1984, the median home price is $76,200, and by October of 2011, and this is post 2007-2008 crash, the median home price is $212,300, which is a increase over 26 years. The change would have been $136,100, which is roughly $5,234 a year. Now, I know that people were not getting $5,234 worth of raises per year. Not even close. Not a chance. Yet housing prices keep to go up like that. Wage growth is not staying the same. And so no longer do you have a healthy paradigm where housing is roughly 1/3 of your overall income. So it's an increase, or in roughly 26 years, it's an increase of 178, over 178%, which is, quite frankly, pretty crazy. So what's the point of all this? What does this really boil down to? Well, it boils down to petrodollar's dying. So we're going to have a new monetary system. Now, the monetary systems can go a couple of different ways, and I've already discussed this in another video about the potentialities, about going to an SDR, through the Bank of International Settlements, to the BIS. It could go to gold silver standard. Again, it could go to a nationalized bank. We could have a series of public banks instead of private banks. The Federal Reserve could continue on. Central banks could continue on in the form of a larger Bank of International Settlements with a special drawing rights basket of currencies. So there's a lot of different ways that it can go, but the important part to remember is, what is your house really worth? Because you could be entering a hyperinflationary period, worst case scenario, hyperinflationary period on most real goods. So like, tires, food, gas, hyperinflationary period. But for your home and for your wages, they're probably not going to go up. And this happened in the 1970s. They call it stagflation. Similar type of thing is probably going to happen now. That's the way that I see it going. So your house, your hard asset, is probably going to end up losing a lot of value because nobody has any money to purchase it. See what I'm saying? So while the cost of, sugar, coffee, whatever goes up, housing prices are going to go down to something where people of my generation can afford them. See, in this country, the baby boomers have had kind of a lock on the political system because they've had a bigger group. They had the largest demographic, and the conventional wisdom of their period was to be able to kind of leverage your house and use the equity out of the house. And banks love this fractional reserve lending. The people loved it because they could use their house as an ATM, and all that partying and acid dropping that they did in the 1960s and their free love revolution, that very where they were not as responsible as their parents' generation. Well, they kind of had to game a system because they didn't have any retirement plans. They didn't save. They partied it up, did a lot of drugs. Okay, so, sex, drugs, and rock and roll. And they were going to kick the can down the road, well, to my generation. And the chickens are coming home to roost. And I got bad news for you. If you think that we're going to pay what you need to live off of for your house, because we don't have that money. Okay, we make real wages out here. And they're wildly distorted. I mean, I'm seeing situations where I have, you see somebody that has a degree, that's highly educated, that's doing something in the medical profession, working overnights, and, has letters behind their name. I've got letters behind my name and finance and other things like that. But I wouldn't earn any more than I would be if I was managing a Taco Bell. I see world-class guys, and this is not to disparage anybody that works at Taco Bell. I'm just saying that there's no real valuation when it comes to the level of education or time that you've had to put in, time that you've had to invest in yourself, and also the other difficulties, the stresses of the job. Like if you're working in medicine, you have to see trauma, all these other different types of things. There's not really any proper valuation in that either. It's a little bit too consistently low all the way across. So, the guy working in the warehouse is making as much as the person in medicine, the person that's certified in, inspections and construction and all kinds of that require certification or anything like that, essentially is not making a whole lot more than somebody that's, didn't require any education or any certification. So the valuations are all screwed up there. And then, not to mention the debt loads, but those are other factors that we'll talk about when we go to really analyze the new valuations, because whether you like it or not, it's going to be the 30-somethings. Political power always passes to the 30-somethings, no matter how big your demographic is, because we're the ones that are going to be carrying the load of society, and we're the ones that have families now and children coming up behind us. So we ultimately will make policy one way or the other. Like I say, the chickens are already coming home to roost. This is something my generation has been waiting on for a very long time. Bloomberg came out and accused the millennials of becoming a renter nation and all this stuff, like, oh, it's our fault that we don't want to take all this risk, and then the insurance risk and possibility of things happening to the house, the liability, owing the bank more than what the house is worth, having to pay interest on it, not being able to rely on a fixed rate, possibilities that your mortgages are going to change all the time. And then having to maintain and everything like that. And then they have the freaking chutzpah, the balls to tell us that we're the screwed up ones because we want to rent, because we don't have to assume any liabilities. But things will return to fair value. I'm just saying that if you're relying on your house as an ATM, you could be in really deep trouble, because it's going to go back to probably, I would say, a good place to start would be 82. But that's for new homes. So if you have an older home, you think about all these other little things in here that we're going to get you for. Depreciation. Love depreciation. You know, and we know what it takes to build a house. We know what it takes for a parcel of land. I was construction for many, many years. We know what a yard of concrete costs. We know what lumber costs. We know what PVC and copper wire, and you know, we can build houses, and we know what the materials cost. We know what the labor costs. So we can't justify, no thinking person can justify a housing price of, well, I guess the average in 2011 was $242,300. Telling you, brick, PVC, vinyl shutters, a couple coats of paint, it's not going to add up to almost $250,000. Sorry, folks. So basically what I'm trying to stress to you is that your home is not your retirement. And with Social Security probably going to be stressed, pension plans probably are going to go bust. It's going to be very important for your communities to be very active in making sure that old people are not put out on the street, because in my estimation, from my perspective, the most valuable asset to any community is its elderly, because when you put that much experience together, you have historical record, you have everything you need to know if you have the patience to listen. I've never been the smartest guy in the room, but what I try and do is I try and find the most experienced and the smartest guys in the room and just stand next to them and listen and pick up what I can. So we'll carry on with the next piece of the valuations as we move forward. Now, as the market's crashing, they could do another correct, you know, they could pump more QE into it or whatever. It's really not going to make any difference, because none of that is increasing the M2 or the money supply. The money velocity is not increasing out here on the street. People are not getting the raises. So you're not going to get the money for the houses. Believe me, the banks would like to offload those houses. They just have to keep the prices pumped up to make sure that people can take the money out in the, so they can mortgage their properties over and over and over again to pay for their retirements that they don't have. And that's why there's kind of been a nod and a wink between the political class and the baby boomer generation, because this is what they relied on for their retirement. And it doesn't have any bearing in reality. And unfortunately, well, there's going to have to be a correction. So, yeah, I think the 80s is a good place to start. I think 82 is a good place to start. So, and we'll see what way it goes. It's been Hank. Catch you on the flip side.